Today, our mission is navigating one of the most critical and, frankly, one of the most confusing hurdles in trading, choosing a reliable Forex broker. Based on everything you've shared with us, this topic is just loaded with marketing noise, high-stakes warnings. So we're going to cut through all of that. We want to give you the non-negotiable standards to make sure your first step is safe, it's compliant, and it's focused on learning. Basically, the shortcut to competence. So let's start at the very, very beginning. You decide to trade currencies, and you realize pretty quick you can't just, plug into the global market. A broker is mandatory. So before we even get to safety, what exactly is a broker doing for us? Why is that intermediary role so fundamental?
That's the absolute foundation of retail trading. The currency market, it's dominated by huge institutions, banks, governments, what we call the interbank market. And access to that, it's just not granted to an individual with a small account.
Okay, so they're the bridge.
They are the essential bridge. The sources are extremely clear that the core function they must provide is that access. So that includes your account, the trading platform.
Like software, yeah.
Right, the software you use to see charts and place orders, and of course, order execution and customer support. Without them, you just can't participate.
But because they're the mandatory gatekeepers, there are these massive conspiracy theories out there, the house is cheating. So if we're looking for a reliable partner, what do reputable brokers explicitly not do? Especially for those who are worried they're being sabotaged.
It's so important to dispel those myths right away. A reputable broker absolutely does not control the price.
Oh, can they not?
Well, the price is derived from these massive global liquidity pools. A single retail broker just doesn't have the volume to manipulate, say, the USD pair.
Yeah.
And they also don't determine if you win or lose. Your strategy, your risk management, that's what does it.
And the big one, stop hunting.
Right. Despite that very common fear, which is usually a result of poor risk management, not sabotage-regulated brokers do not hunt your stocks. Their business model is volume. It's transaction fees.
Not stealing a $100 deposit.
Exactly. The moment a broker starts doing that, they risk their regulatory status, and that's a multi-million-dollar liability they just won't take on.
That makes perfect sense. The market's too big. And that brings us to the main point. If you, the listener, only remember one thing from this entire deep dive, what is that single, absolute, non-negotiable?
Regulation. Just regulation. Everything else, the spreads, the leverage, the platform's color scheme, it's all completely secondary until you confirm they're operating under a legit, enforceable regulatory framework.
So choosing an unregulated broker is low.
You're operating in the Wild West. You have zero recourse if they decide to cheat you.
Okay, so let's break that down. Why does regulation provide such a crucial shield? It's not just a stamp of approval, right? It's actual legal protection.
Yeah, it is. The biggest thing is that regulation transforms your broker from just a business partner into a safeguarded custodian of your funds. The primary protection mentioned in the sources is the requirement for brokers to keep client funds in what are called segregated accounts.
Segregated accounts. And that's critical because
It means your trading capital is legally separate from the company's own operational money. So if the brokerage gets into financial trouble or even goes bankrupt,
their creditors can't come after my money.
exactly, they cannot touch your money. It's held in trust, waiting to be returned to you.
That is massive. And I imagine that rule came about because of some major crisis where people lost everything.
Precisely. These protections are hard-won. They exist because, historically, when brokers failed, clients were just another creditor in a long line. Segregation was mandated to protect client capital, period.
What else does regulation give us?
Well, beyond segregation, regulated brokers have to submit to regular audits, they have to follow strict operational rules, and maintain minimum capital requirements for stability, and then there's negative balance protection.
That's the safety net that stops you from losing more money than you actually have in your account.
Yes. It ensures your account can never go below zero. It's a vital protection, especially with high leverage, and it's legally required in places like the UK and the EU.
So our sources mention this alphabet soup of regulators, FCA, NFA, ASIC, CISEC. They're not all the same, are they?
Not at all. You can think of them in about 3 tiers. First, you've got the FCA in the UK and ASIC in Australia. These are, universally seen as the gold standards.
Very strict, high client protection.
Extremely high. If
Yeah.
you live in or near those regions, choosing a broker regulated by them is probably your safest bet.
Okay, and then you have the U.S.
The U.S. environment, yeah, governed by the NFA and CFTC. This is the most restrictive jurisdiction in the world. The client protection is arguably the highest, but the restrictions are severe.
Most notably, the 50-to-1 maximum leverage rule.
That's the one. It's the biggest differentiator.
But doesn't that restriction actually push some experienced U.S. traders to go find an offshore, unregulated broker just to get more leverage?
It absolutely does. The sources acknowledge that trade-off. It's a classic security versus freedom debate. The NFA believes low leverage is the ultimate safety measure.
But for a sophisticated trader, it feels too limiting.
Exactly. It pushes them to risk their capital with an unregulated entity just to get ratios like 500 to 1. But the lesson for a beginner is simple. If you have to choose between safety and high leverage, you choose safety every single time.
Your risk plan should determine your leverage, not the broker's maximum offer.
100%. And
Yeah.
finally, you have the broader EU environment, often managed through CISIS in Cyprus. It's decent enforced regulation. Importantly, it offers EU passporting rights, so a CISIS broker can operate across the whole EU.
And the others.
Well, you have to be a bit more cautious with Tier 3 regulators, like the FSCA or FSA Seychelles. The sources note the quality and enforceability of the regulation there it can vary a lot.
So the bottom line is stark. Avoid the siren song of the unregulated broker, no matter what they promise.
That is the essential warning. They promise the world because they have zero accountability. If they refuse your withdrawal or vanish, you have no legal recourse. You might save a few pennies on commission, but you're risking 100% of your capital.
Okay, safety shield is in place. We've confirmed regulation. Now let's talk practical features. For a beginner with smaller capital, say, that 100 pounds to 250 pounds account, what should they actually prioritize?
The focus shifts entirely to features that enable proper risk management.
Okay, number one.
Micro lot capability. You absolutely must be able to trade zero point 0.01 lots or smaller. A beginner cannot implement proper risk management, like risking 1% of a $200 account, without trading micro lots.
Because if you're forced to trade many lots, you're over-leveraging from the start.
Instantly, you're guaranteed to blow up your account.
And that connects right to the minimum deposit. You're not trying to get rich, you're buying cheap tuition.
That's a great way to put it. Your initial capital is tuition for the hardest course you'll ever take. So the recommended minimum deposit is low, 100 pounds to 250 pounds. If a broker demands 1,000 pounds or more, they're not for beginners.
Got it. What about costs, like spreads?
You want reasonable spreads. For a major pair like UUSD, you should expect something between, say, 0.6 to 1.5 pips.
But there's a catch there, right?
There is a critical note from the sources. Always check the spread during the liquid London and New York sessions. Brokers often widen spreads during the low liquidity Asian session, and that number isn't what you'll usually be paying.
And for the platform, keep it simple.
Keep it very simple. Stick to the industry standard. MetaTrader 4 or 5, MT4 or MT5. They're robust, clean, reliable, and they have the biggest community for support, for indicators, tutorials, everything.
So if a broker's pushing their own fancy custom platform instead.
It's just an unnecessary headache for a learner.
And we should just reiterate negative balance protection, even if it's optional outside the UK or EU.
It's a marker of good faith. A broker who offers it when they don't have to is showing they prioritize client safety. It's an insurance policy you hope you never need.
Okay, now for the really interesting part. The marketing traps. The features that are totally irrelevant or even harmful for someone who's just learning.
Right. Most marketing is designed to make you feel like you can bypass the hard work of learning.
So what should we ignore?
First, ignore the broker's advanced charting tools. Chances are you will quickly migrate to a professional platform like TradingView for your analysis anyway. Their tools are just better, and they're standardized.
What about social or copy trading? That sounds so appealing for a beginner. Just follow a pro.
It creates total dependency. It gives you the illusion of instant results, but you skip the most vital stage, learning how to analyze, manage risk, and take responsibility for your own trades.
You're not learning the process.
You're just placing blind bets on someone else's risk profile. It's a dependency model, not a learning model.
And what about their free educational courses?
The sources suggest these are often just thinly veiled marketing materials. They're designed to get you comfortable with their platform, not to provide a rigorous education. And definitely be skeptical of any AI-powered tools.
Emacs.
Overwhelmingly gimmicks that replace the actual work you need to do.
And the biggest temptation of all, The huge welcome bonuses, the 100% matching bonus offers.
You have to look the other way. They almost always come with highly restrictive withdrawal terms. You have to trade some astronomical volume before you can withdraw the bonus money.
And sometimes your own money.
Sometimes even your own deposited funds. It just creates complications and locks you in. The priority has to remain on regulation, simplicity, and ease of withdrawal.
That sets us up perfectly for the actionable guide. Let's give the listener the step-by-step roadmap. Step 1. Verify regulation. We've stressed this, but how does someone actually do that due diligence?
You must not trust the broker's website. They can easily copy and paste a logo. You have to find their regulatory number, which they should display, and then go directly to the regulator's official website, the FCA, ASIC, NFA.
And use their search tool.
Use their public search tool to verify that number is valid and the broker's legal name matches. If you can't verify it with the regulator, walk away, period.
Okay. Step 2, test with a demo account.
Right. Get hands-on before you commit any real capital. Use it as a risk-free trial. Check the platform. Test the order execution speeds. Get a feel for how it works. Is it stable? Does it crash?
And then step 3.
Yeah.
This feels like the most critical real-world test in the whole process.
It is. Start with a minimum deposit and test the withdrawal. Deposit that small amount, that £100 or £250, but then, after your first few trades, immediately test the withdrawal process.
With a small amount, like 20 quid.
Exactly, 20 or £50. Can you get your money out easily? A reliable, regulated broker should process that in 1 to 3 business days, no questions asked.
That's the real moment of truth. If they fight you on that small withdrawal, it doesn't matter how good anything else is.
It doesn't matter. If it's easy to deposit but hard to withdraw, that is a massive red flag. You move on.
And only after they pass that test.
Only after 2 or 3 months of a smooth experience and successful withdrawal testing do you move to step 4. Gradually increase if satisfied. Your confidence has to be earned.
Let's wrap up with the most common pitfalls the sources point out. What mistakes do people keep making?
They fall for the vanity metrics. Mistake number 1. Choosing a broker based on insane leverage, 500 to 1 leverage, is irrelevant and dangerous for a beginner. You should be focused on not using high leverage. Mistake 2. Choosing based on deposit bonuses, which, as we said, just restrict your liquidity.
And ignoring verified safety for, what, a few good online reviews?
That can be fatal. Ignoring direct regulatory verification because the reviews look good is so risky. Reviews can be faked. A valid registration number on the FCA website cannot. Always trust the regulator over the reviewer.
And the last one?
Constantly switching brokers. Chasing a tiny theoretical advantage, like a spread that's 0.1 pick lower, just creates instability. It wastes time you should be spending on your actual strategy.
So find one regulated, simple broker, run through those 4 steps, and then commit to it. That consistency is way more valuable. Okay, let's recap the core takeaways. Regulation is paramount, and you must verify it on the regulator site, not the brokers. Simplicity helps you learn MT4 or MT5, micro lots, those are essential. And the most vital safety check is testing that withdrawal process early on.
And if we connect this to the bigger picture, the sources are overwhelming. Your choice of broker, while critical for safety, is purely operational. It does not determine if you succeed or fail.
Right.
Finding one good, simple broker and sticking with it leads to more consistent learning and execution than constantly chasing some non-existent edge.
And that leaves us with a final provocative thought for you, the listener. Since your success hinges on your skills, not your broker, what essential skill or core piece of knowledge outside of broker selection, maybe it's rigorous risk sizing, developing a strategy, or mastering psychological discipline, what one thing should you commit to mastering over the next 3 months to truly leverage your new regulated account? Think about that commitment, and we'll see you on the next deep dive.